Johnson & Johnson stock, ticker symbol JNJ, is only up 8% in the past 5 years. They are reporting earnings next Wednesday, this 17th of July, and in this video, I am going to do an in-depth analysis of the company by looking at the financials, the forecast, some important statistics, using my discounted cash flow and net income model to calculate the intrinsic value of the company, and also revealing whether or not I am adding it to the YouTube stock portfolio. First of all, this is a very popular stock among the dividend community, as they have a dividend yield of 3.33%, which accounts for $5.20 per share. If we take a look at the dividend more in depth, we are going to see that the payout ratio is 55.8%. This means that it takes more than half of their net income to pay the dividend. Johnson & Johnson is not going to stop paying their dividend, as their first dividend was paid in 1944, and they have continuously been paying it over the past 60 years, increasing it every year. If we take a look at their financials, Johnson & Johnson's revenue has grown very little over the past 5 years, going from $82 billion to $89.3 currently. And if we take a look at their profit, we're going to see that their net income has also seen very little growth, except for 2023, which in my opinion was a fluke year, and it is currently at $21 billion. Then, free cash flow as well has also been at around $20 billion, with basically no growth over the past 5 years. Now, one thing that I do like about this company is that they have been buying back shares. This is very positive for investors, as you own more of the company and you will get better stock returns basically by doing nothing. And later we will see how it affects future returns in the Excel spreadsheet. If we take a look at some important statistics, they have an okay balance sheet with $38 billion in cash and $52.2 billion in debt. So they have a little bit of debt, but nothing that worries me for such a large company, as the company currently has a market cap of $373 billion. Then, taking a look at the valuation, they are currently trading at a P of 17, a forward PE of 14, and a price to free cash flow of 18. So it seems decently valued, but in order to take a deeper look at the valuation, I use my Google Sheet. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with a low case, middle case, and high case. According to my low case, the intrinsic value is $116 per share, middle case $155, and high $204 per share. This also means that if my low case occur, you're going to make a 4.7 annual % return on your money, middle 10%, and high 15.2%. So it does seem like the company is fairly valued, but not heavily discounted. I also want to add that these returns here include the dividend. Why? Because dividends come from free cash flow and profit, so you cannot double count it. As far as my assumptions, I assumed 1% annual revenue growth rate for the next 7 years on my low case, 3% in the middle, and 5% on the high. For profit margin and free cash flow margin, I did 21%, 23, and 25. For P and price to free cash flow at the end of the 7 years, I did 15, 17, and 19. And finally, I assume they buy back 2% of their shares every year for the next 7 years, because this is what they have been doing. However, as I said before, if they don't do this, the intrinsic value decreases substantially, as you can see here. So I hope they continue to buy back cheap shares. Now, as far as whether I'm going to add it to the YouTube stock portfolio, the answer is no, as I prefer to buy stocks that I believe are heavily discounted. For example, we own Baba, PayPal, Walgreens, and SoFi. So far, they have done very well, with the exception of Walgreens. And Johnson & Johnson, I believe, is decently priced, but not heavily discounted. I am personally interested at around $120 per share, although it hasn't reached that level in 5 years. I hope you found this video valuable. Let me know what you think about JNJ stock in the comments, and I'll see you in the next one.